Developing a Forex trading plan. A beginner's roadmap. A well-defined trading plan is crucial for success in Forex trading. It serves as a roadmap that outlines your trading goals, strategies, risk management techniques, and criteria for entering and exiting trades. Developing a trading plan helps you stay disciplined, minimize emotional decision-making, and increase your chances of consistent profitability. Here's a step-by-step roadmap for developing a Forex trading plan as a beginner. Step 1. Define your trading goals. Start by setting clear and realistic trading goals. Determine what you aim to achieve through Forex trading. Your goals could include generating a certain percentage of return on investment, achieving a specific number of profitable trades per month, or building a consistent income stream from trading. Make sure your goals are specific, measurable, attainable, relevant, and time-bound. SMART goals. Step 2. Determine your trading style and time frame. Decide on the trading style and time frame that aligns with your personality, lifestyle, and trading goals. Are you more inclined towards day trading, swing trading, or long-term position trading? Choose a trading style that suits your preferences and allows you to effectively execute your trading strategies. Step 3. Select your trading strategies and tools. Research and select trading strategies that align with your trading style and goals. There are various strategies to choose from, such as trend following, range trading, breakout trading, or mean reversion. Determine the indicators, chart patterns, or other tools you will use to identify potential trade setups and make informed trading decisions. Step 4. Risk management techniques. Developing proper risk management techniques is essential for preserving your trading capital and managing potential losses. Determine your risk tolerance and establish rules for position sizing, stop-loss placement, and take-profit targets. Decide on the maximum percentage of your trading capital you are willing to risk on each trade. A common rule of thumb is to risk no more than 1 to 2% of your capital on a single trade. Step 5. Entry and exit criteria. Define clear and objective criteria for entering and exiting trades. This could include specific technical indicators, chart patterns, or fundamental factors that signal potential entry points. Similarly, establish criteria for exiting trades, whether it's a predetermined profit target, trailing stop-loss, or a specific technical signal indicating a trend reversal. Step 6. Backtesting and demo trading. Before implementing your trading plan in live markets, it's crucial to backtest your strategies and practice on demo accounts. Backtesting involves applying your trading plan to historical market data to evaluate its performance and profitability. Demo trading allows you to practice executing trades and following your plan in a risk-free environment. Use these stages to refine and fine-tune your trading plan. Step 7. Document your trading plan. Once you have determined your trading goals, strategies, risk management techniques, and entry and exit criteria, document your trading plan in a clear and concise manner. Writing down your plan helps reinforce your commitment to following it and serves as a reference for consistent decision-making. Step 8. Review and evaluate. Regularly review and evaluate your trading plan to ensure it remains effective and aligned with your trading goals. Monitor your trading performance, identify strengths and weaknesses, and make necessary adjustments to improve your plan over time. Keep a trading journal to record your trades, emotions, and lessons learned for further analysis. Step 9. Stick to your trading plan. The most important aspect of developing a trading plan is to have the discipline to stick to it. Avoid impulsive trading decisions based on emotions or market noise. Trust your plan and follow it consistently, even during periods of drawdown or market volatility. This discipline will help you stay focused and increase your chances of success in the long run. Conclusion. Developing a Forex trading plan is a critical step for beginners. It provides structure, discipline, and a clear roadmap for your trading activities. By setting goals, defining your trading style, selecting appropriate strategies, implementing risk management techniques, establishing entry and exit criteria, backtesting and demo trading, documenting your plan, and regularly reviewing and evaluating your performance, you can develop a robust trading plan that supports your journey to becoming a successful Forex trader. Remember, flexibility and adaptation are also important as market conditions evolve, so be open to making adjustments to your plan when necessary.